Precious metals retail has been treated as a simple business built on trust, inventory, and steady margins. But that assumption is starting to fray at the edges as structural pressures quietly accumulate beneath the surface. At the storefront level, many gold and silver shops still look unchanged, yet the mechanics behind the counter are shifting in ways customers rarely see, and those shifts are beginning to compress margins in places that once felt stable, setting up stresses that haven't fully surfaced yet. Behind the scenes, wholesale sourcing has become less predictable, not because metal is unavailable in an absolute sense, but because delivery timing, lot sizes, and pricing windows are behaving less reliably than historical norms, and that uncertainty is starting to flow downstream. On the pricing side, spreads that once absorbed volatility are narrowing, as competition and transparency force retailers to quote tighter numbers while their own acquisition costs fluctuate more erratically than their customers realize. At the same time, customer behavior is subtly changing, with buyers expecting instant availability and institutional-style pricing even as physical supply chains remain fragmented, creating a mismatch that shops are increasingly forced to absorb. Beneath all of this, regulatory and financial plumbing is tightening quietly, altering how inventory is financed, insured, and hedged, which may not show up on a receipt but directly affects which shops can stay liquid during periods of stress. Taken together, these pressures don't point to a sudden collapse, but they do suggest a narrowing path forward for certain operators, and the reasons why become clearer once you look at who's exposed first. What separates resilient shops from vulnerable ones starts with how they fund their inventory, because the quiet return of higher carrying costs is changing the math in ways many operators haven't had to confront in years. For a long time, access to short-term credit and flexible supplier terms allowed dealers to hold larger inventories without feeling immediate pressure. But as financing terms tighten, metal sitting in a safe now represents tied-up capital rather than optional stock. Some shops rely on rapid turnover to offset this, yet turnover itself has become less reliable as customer demand arrives in uneven bursts rather than predictable flows, leaving inventory stranded at precisely the wrong moments. Hedging, once a buffer against price swings, is becoming more complex and expensive, and for smaller dealers, the tools that once smoothed volatility are now introducing new risks they're not structurally equipped to manage. Even well-run operations are discovering that slight delays in delivery or settlement can cascade into liquidity stress, not because of mismanagement, but because the margin for error has quietly narrowed. This is where scale starts to matter, as larger players can renegotiate terms or absorb temporary mismatches, while independent shops feel the pressure immediately and often invisibly. As these financial constraints tighten, they begin to shape not just balance sheets, but day-to-day decisions on pricing, availability, and customer relationships. And that's where the next layer of pressure starts to emerge. Pricing is where these stresses become visible, even if customers don't immediately recognize what they're seeing, because the numbers on the board now carry more risk than they used to. When spot prices move quickly, some shops hesitate to update quotes in real time, not out of caution, but because replacing sold inventory at the same price is no longer guaranteed within the same window. This leads to subtle changes in behavior: wider buy-sell spreads during volatile sessions, temporary pauses on certain products, or a quiet preference for items that can be sourced more reliably, even if demand points elsewhere. Customers notice inconsistency before they understand the cause, and trust, once shaken, is hard to rebuild in a business that relies on repeat transactions and word-of-mouth reputation. Online competition amplifies this effect, as national platforms can quote aggressively and absorb short-term losses, while local shops are forced to choose between protecting margins and maintaining customer loyalty. Over time, this tension pushes some dealers into a defensive posture, where preserving cash takes priority over market share, even as that choice slowly erodes their visibility and relevance. The pricing pressure doesn't break shops overnight, but it creates a feedback loop where caution leads to lower volume tightens finances, and the room to maneuver keeps shrinking. That loop becomes more dangerous once external factors start to interact with it, and those factors aren't coming from the retail side at all. Beyond retail dynamics, pressures are building from the institutional side of the market, where decisions made far from the shop floor are beginning to influence who gets metal, when, and under what terms. Refiners and mints are operating under stricter risk controls, prioritizing counterparties with scale, balance sheet strength, and predictable volumes, which subtly pushes smaller buyers toward longer wait times or less favorable allocations. This doesn't mean metal disappears, but it does mean access becomes tiered, and shops without long-standing relationships may find themselves competing for secondary supply at moments when timing matters most. Logistics add another layer, as shipping costs, insurance requirements, and compliance checks introduce friction that accumulates quietly, turning what used to be routine restocking into a planning exercise. When delays occur, they don't just affect inventory levels, they affect credibility, especially when customers are promised delivery windows that the shop no longer fully controls. Larger dealers can smooth these disruptions by shifting flows internally, but independent shops often face binary outcomes, either disappoint customers or tie up more capital to build buffers they can't easily afford. As institutional preferences continue to harden, the gap between those with direct access and those relying on intermediaries widens, and that gap becomes a fault line during periods of stress. That fault line matters most when market sentiment shifts abruptly, because that's when hidden fragilities tend to surface. Market sentiment is the accelerant that turns structural strain into visible pressure, and precious metals have a long history of attracting sudden, uneven demand when confidence elsewhere falters. During these surges, shops face a paradox. Demand rises just as sourcing becomes more difficult, and prices move faster than replacement inventory can be secured. Some dealers respond by limiting sales or favoring established clients, a rational choice internally, but one that can alienate new buyers and feed perceptions of scarcity or unfair pricing. Others attempt to stay fully open, quoting aggressively to capture volume, only to discover later that replenishment costs erase the profit they thought they'd locked in. These moments reveal which operations have flexibility and which are operating close to the edge, because stress doesn't come from high prices alone, but from speed and unpredictability. Customer psychology also shifts during these periods, with buyers less tolerant of delays and more sensitive to perceived spreads, intensifying scrutiny on every transaction. What looks like strong demand from the outside can mask rising internal risk as cash inflows arrive unevenly and obligations stack up behind the scenes. By the time sentiment cools, some shops find they've taken on exposures they can't easily unwind, and the after effects linger long after headlines move on. Those lingering effects don't stay confined to individual shops because they interact with another quiet constraint that's tightening in parallel. Another constraint tightening quietly is compliance, not in the dramatic sense of new rules announced overnight, but through gradual enforcement shifts that change how precious metals businesses are expected to operate. Reporting thresholds, customer verification, and transaction monitoring have existed for years, yet the tolerance for informal processes is shrinking, increasing administrative load and operational risk for shops that were built to move metal, not manage paperwork. For larger firms, compliance costs scale efficiently, but for small operators they act like a fixed tax, consuming time, cash, and attention that would otherwise go towards sourcing and customer service. Mistakes don't have to be severe to be costly, because even minor compliance issues can delay banking relationships, freeze accounts temporarily, or introduce scrutiny that disrupts day-to-day operations. This creates a chilling effect, where some shops reduce transaction sizes, limit certain payment methods, or avoid borderline customers altogether, narrowing their own revenue base in the process. Banks, facing their own pressures, are less inclined to accommodate exceptions, and once a relationship becomes strained, replacing it is rarely quick or straightforward. What emerges is a quiet sorting mechanism where only shops with the systems and capital to adapt remain fully functional, while others operate under growing constraints they don't publicly acknowledge. These pressures don't announce themselves, but they compound with every other strain already in place, setting the stage for outcomes that only become obvious after the fact. As these layers converge, the business model itself starts to narrow, and some shops are discovering that the flexibility they once relied on is no longer there when they need it. Margins that looked acceptable in isolation begin to fail under combined pressure from financing costs, compliance overhead, and less favorable sourcing terms, leaving little room for error. In response, certain dealers quietly shift product mixes, emphasizing higher premium items or numismatics, not because demand naturally moved there, but because those categories offer more cushion against volatility. That shift carries its own risks. as slower moving inventory ties up capital longer and depends heavily on sustained buyer interest, which can evaporate quickly if sentiment changes. Others lean harder into buybacks, using customer selling as a source of inventory, yet that strategy depends on continuous flow and trust, both of which weaken during uncertain periods. What's striking is that many of these adaptations are rational on their own, but together they signal a sector becoming more defensive, less liquid, and more sensitive to shocks. By this stage, vulnerability isn't always visible from the outside. Shops may appear busy or profitable, even as internal resilience erodes. That erosion matters because it shapes how the industry reacts to the next disruption, and by then, the options available may be far more limited than they appear today. By the time these pressures fully register, the outcome isn't a dramatic wave of closures, but a quieter reshaping of who can operate comfortably and who is forced into survival mode. Some shops will consolidate, sell quietly, or reduce their physical presence, not because demand vanished, but because the risk-adjusted return no longer justifies the complexity and exposure. Others will remain open but change character, holding less inventory, quoting more cautiously, and relying on tighter client relationships rather than walk-in volume. From the outside, this can look like normal business evolution, yet beneath it is a thinning of capacity that matters during moments of stress, when access to physical metal becomes most sensitive. What makes the 2026 window notable isn't a single trigger, but the convergence of cycles, where financial conditions, institutional behavior, and retail constraints overlap more tightly than they have in years. In that environment, even modest disruptions can have outsized effects, not because the system is fragile everywhere, but because flexibility has been used up gradually and unevenly. The shops that remain resilient will likely be those that anticipated these shifts early, while others discover too late that the rules changed without an announcement. What that means for buyers, pricing, and availability depends on how this transition finishes unfolding, and that's where the final implications start to come into focus. What follows from this isn't a warning about metal itself, but about access, structure, and timing, because markets rarely fail at the point people expect. When retail capacity thins, price discovery becomes less smooth, spreads react faster to stress, and availability shifts from being a constant to being conditional. Buyers accustomed to choice and immediacy may find that relationships matter more than price quotes, and that reliability carries a premium that didn't used to exist. For shops, survival won't hinge on predicting price direction, but on managing risk in an environment where small missteps compound quickly. None of this implies an end to physical gold and silver retail, but it does suggest a transition toward fewer, more controlled access points during periods of heightened demand. By the time these dynamics are obvious to everyone, the adjustment will already have taken place, quietly altering how the market functions. The pressure isn't about collapse, but compression, and compression tends to reveal where resilience was real and where it was assumed. That distinction is likely to define the precious metals retail landscape well before the calendar makes it official.